On today's show, it's all about high risk, high reward dividend stocks. Grab yourself a brew and let's start right now. When it comes to dividends, I am absolutely a huge fan of passive income. There is nothing quite like that feeling of opening up your email in the morning and finding out that some dividends have arrived while you were sleeping. That's the truest definition of passive income, if you ask me. We're going to be looking today at high risk, high reward dividends. But before we do that, I just want to sort of define what I mean by a high risk, high reward dividend. And to do that, we'll start with the low risk dividends. Those are what we call the blue chip dividends. So those are, for example, your bank stocks. A lot of your utility stocks, they tend to have a fairly low yield. So most times your blue chip are going to be between 3 and 5%. So you're not getting a lot of bang for your buck, but you're getting stability. You're getting that low risk, which is amazing. These are also very good at weathering poor market conditions. So when we go into a bear market, holding your blue chip dividends is going to be a worry-free experience for sure. Now, if we take it one step further and look at our medium risk dividends, so these are a little bit different. These are your non-blue chip, and they tend to have a positive earnings per share ratio, so EPS. They have a record of consistently making their dividend payouts. That's definitely important. And they tend to be a moderate risk. So some of the income trusts, which includes REITs, which is a real estate income trust, and also some of my favorite stocks, such as my Canoe EIT Income Trust Fund, they would all be considered medium risk dividends. A lot of times they will perform very well throughout the year. They're just not 100% in a bear market. So you want to be definitely monitoring these type of stocks as you go into a bear market and adjust as necessary, of course. We're not here to talk about the medium riskers today. We're actually here because, well, we want to talk about our good old buddies, the high riskers. So high risk dividends. So these have a low, or in some cases even negative, earnings per share. They have a yield of 10% or higher, and they may have inconsistent dividend payouts. Now, the ones I found for you today are actually not that bad to look at. So I've tried to find some of the better ones, and I think luckily they're also very high dividend payouts. So let's actually start taking a look at some of these. We're going to actually begin with a company called Labrador Iron Ore Royalty Corporation. Ticker is LIF. They have a yield of an amazing 12.44%. So that is $1.15 for every share that you own. And I believe their shares are around $36 at the time of filming. They have a lot of volatility in their quarterly dividend. So these are the only ones in the 5 that we're going to talk about today that do a quarterly dividend. The rest of them are all monthly. When I say they have a lot of volatility, what I mean by that is their dividend tends to be almost a bit of a floating dividend. Last quarter, their dividend was above 20%. They were paying, I think, $2.10 per share. Does change quite drastically from month to month. So that's one of the things you want to be aware of when you are looking at Labrador Iron Ore Royalty. They are good. They do have a solid return, and when they do have those quarters where they're doing really well and they pump that dividend way up, they're fantastic on those ones. Absolutely a great target for a dividend capture strategy if you're looking to do that. Labrador Iron Ore Royalty, they are in the steel industry. So they actually hold royalty in IOC, which is the Iron Ore Company of Canada. They have a 7% gross royalty over IOC, and they also receive a 10-cent commission per ton on all iron ore products. So that is where they make their money, and let me tell you, they are doing very well. So our next one is the Canadian Bancorp Class A shares, ticker symbol BK. They provided a yield of 14.27%, so they're paying 16 cents per share. They are a monthly dividend. They also have a pretty low PE, so 1.8 price per earnings ratio, which is nice. Normally, a price to earnings ratio is a good way to get an indication of how they're doing in comparison to somebody in the same market. Now, they are a mutual fund corporation with heavy financial sector investment. which is fantastic. So they are invested in, for example, TD, Scotiabank, most of the Canadian banks, with the main goal of being able to provide, of course, their generous yield that they provide each month. They are a fantastic stock to be purchasing for sure. The third one is Dividend 15 Split Corp Class A shares, DFN. So DFN holds a fantastic yield of 15.15%, which works out to 10 cents per share. They're a monthly dividend. They also have a low PE of 2.3. They are a mutual fund corporation with a heavy diversification and high yield Canadian dividend stocks. They're doing rather well for themselves. Our fourth one is North American Financial 15 Split Corp Class A shares, FFN. They have a fantastic yield of 18.31%. So you're looking at 11 cents per share. They have a monthly dividend and a very low PE of 1.7. They are an investment company with heavy investment in both the Canadian and American financial sector. So they've got their hands in both pots, and that is just fantastic. They're definitely doing the right thing, and they're making you lots of money. Okay, let's move to our final stock. So our final high-risk, high-reward dividend stock is Dividend 15 Split 2 Class A shares. Ticker symbol is DF. They provide a fantastic, almost unbelievable yield of 19.35%. That works out to 10 cents per share. Now, at the time of recording, their share price was just over $6. So you can definitely build up a lot of dividends really fast with this company. They are, of course, a monthly dividend. They've got a nice low PE of 2.0. They are a mutual fund company, so they have a lot of heavy investment in large cap Canadian companies. So they do have their fingers in a lot of really stable pies. Is that translating to the stability that they have been receiving in the bull market? That's hard to say. It may be a factor for sure. Of course, with all of these high risk, high reward dividend stocks, they should be watched. You should be keeping your eyes on them. And if anything changes with their fundamentals or with their dividends, be prepared to move some of this investment back to your more lower risk stocks. Especially as we move into a bear market, I will probably sell off all of my high risk stocks, move them all down to low risks to ride out the bear market when we get there. I don't think we're getting there anytime soon, but nobody can ever really predict it until after the fact. If these are stocks you are interested in adding to your portfolio, I would recommend using Wealthsimple for the simple reason, commission-free, no service charges, and it's a fantastic broker to place your Canadian stocks in. If you have not yet signed up for Wealthsimple, if you go in the about information below, so the more info, you'll find my referral links down there. If you've already signed up for Wealthsimple but have not yet claimed your 2 free stocks, then right above my head, we've got my referral code. You can just enter that in and grab those 2 free stocks. Full disclosure, I do get a stock when you do that, but it's still worth it. You could get an Amazon stock, and let me tell you, you will be very happy if that ends up being one of your free stocks for sure. So if you liked what you've seen in this video today, then of course, hit that like button down below. If you're interested in more content of this nature, then hit subscribe and ring that little bell so you know when I am posting a new video. So until next time, take care. Thank you for dropping by.